Fiscal policy is how the government manages the economy through spending and taxes. Let's break down how these levers actually work. The term fiscal refers to public revenue and government money. It is the primary way lawmakers influence economic growth and stability. Government spending and taxation are the two main tools used. By adjusting these, the government can speed up or slow down the economy. Policy shifts are generally expansionary to encourage spending during a downturn, or contractionary to address high inflation by pulling back on money flow. Don't confuse this with monetary policy. While fiscal policy is set by lawmakers, monetary policy is managed by the central bank. When spending outweighs revenue, it creates a deficit. This balance is a constant tug-of-war in the legislative process. Ultimately, the goal is to keep the country growing while preventing prices from rising too quickly. It is a delicate balancing act. Understanding fiscal policy helps you see the big picture of the economy. Subscribe for more basics and remember, this is not financial advice.